This week, we're supposed to get the September jobs report, which was, second half of August, first half of September. Then it usually reports the first Friday of October. Here we are midway through November. Is it stale data? Yes. But will it confirm a trend?
Money supply because the Fed has been restricted. I'm going to explain that.
Credit card loans, car loans, those are short-term borrowing rates, and they are low right now.
Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop.
Hey, it's KP coming to you live from Corona, California. Back at the desk after traveling. I may have a little hoarse in my breath here, in my voice. I apologize. We had a nice little rain for like a week and flag football Friday night, which was an epic core memory for my 6-year-old daughter and 8-year-old son playing flag football, and they both got a W. So the playoffs continue. But enough about that. Lots going on. We have a Fed meeting coming up. It seems like just 4 weeks away, and maybe 3 weeks away. So the 9th and 10th of December, it will have a dot plot on it. And if you watch the last dots and you want to put any credence into the dots, not the credence into the fog comment that Powell said during a press conference, pretty much everyone that's been speaking has, said pretty much it matches up with all the dots. So now you watch all the Fed speakers this week. So I'll talk about that a little bit. Talk about Jevons Paradox, AI, how it's impacting the world. Nvidia reports earnings this week. I'm not a financial advisor. I am not responsible for your losses, only your profits. And a little disclaimer. So I just want to clear the air. This is just me talking. Kevin Pernio, yes, I am the chief lending officer and a partner here. But I don't speak for the whole company. No one talks to me about what to say. No one asks me what to say. It's just me hopping on here on Mondays and Thursday nights, sometimes different odd times, depending on how the road life works. But this is just my opinions. So nobody, does anything with their content that's, I think, out of the norm. I've seen it kind of reposted somewhere in there, but it's just me talking. So we have a fantastic leadership team. A phenomenal senior management team. I've got 3 partners, Paul and Robert, who founded this company. We are heading into our 25th year of existence, which is pretty cool. So there will be some marketing around that. I don't like to talk too much about PRMG. I just like to talk about stuff that's on my mind. So this is my diary, my psychotherapist with you, my community, our comments down below, the itch I scratch from wanting to be a news reporter or whatever. So just thought I'd throw it out there. Okay. NAR data through the midpoint of the year, the first-time homebuyer age is up from 38 to 40. Now, I will say that is mostly attributed to home affordability, higher prices, higher rates, higher insurance, higher taxes, higher everything. Although eggs have been coming down lately, but wheat is up, natural gas futures is up, oil's been down pretty consistently. So it's just expensive to live. Having said that, people are waiting longer to get married and have children, which are, deployment, diamonds, diapers, these D's, they impact when people get a house. And so there is also a component there too, that there is a dynamic shift, in the way people live in America and get to a point where they want to buy a house. I read a Harvard joint studies on housing report said that renting is a lifestyle. It's not just a backup plan. So there are people that like to rent, and rent's coming down. So for 3 months now, the good folks at MBS Highway pointed out today, you look at some of the data out there, whether it's Trueflation or current rent numbers, not a owner's equivalent rent or rent in an index that the Bureau of Labor Statistics puts out, which has 12 different monthly readings from 12 months ago and 11 months ago and 10. And like right now, the last 3 months, rent prices for new rents are down. So that's good for inflation. And so people, maybe they can't buy near a live, work, play place or an attraction or, a beach or whatever. And they would either just pay the rent right? So 100% interest rate making a landlord rich. Maybe a 50-year mortgage could help them. I'm not saying it would near the beach, but I don't live near the beach. I'm miles away. Anyway, 40 years is the first time homebuyer age. 62, which is another number that's up highest on record that NAR reported, for repeat home buyers, a home seller. So like roughly like 75% of people that sell a home buy another home. And 62 is the age for the median age for repeat home buyers. All buyers' median age is 59. And what I thought was the lowest reading on record, 21% of all home buyers are first-time home buyers. That's not good because a lot of originators really do a good job of helping first-time home buyers and doing that financial literacy teaching and being the front line of defense. And so a lot of first-time home buyers are a way where realtors and originators on the front line, show their value. So lower rates cures a lot. I'm not saying it's the end all be all. The non-bank share of owned servicing keeps ticking up. I think through the midpoint of the year, 59%. So among the top 50 firms that own servicing, 59% share through June of 25. I thought that was interesting. Okay, what is the Fed going to do? All right. So we're only at 6 minutes here. I'm going to be real brief. I think they do a hawkish cut. Okay. So they said they want to cut, quick look at, labor and what's going on. We've had a lot of weakening labor. That is the trend. Yes, the government is reopened. Yay. Until the end of January, which means we may be doing this all over again. Wouldn't surprise me. So there's still some uncertainty out there with this government shutdown being over because only parts of it are over. So kind of break it up into different bills. We'll fund this thing and this thing and this thing, but these things we'll have to retalk about it in January. But we want to up-down vote based on extending the Affordable Care Act credits to decide whether we think we should fund our government. Anyway, this labor data that hasn't been coming out, it's not like there isn't data. We know there's data. Each Fed has their own data that they look at. They know what's going on. We see data. This week, we're supposed to get the September jobs report, which was, second half of August, first half of September. Then it usually reports the first Friday of October. Here we are midway through November. Is it stale data? Yes. But will it confirm a trend? Or will it highlight a potential reversal? So Nvidia's highway team thinks that the expectation is 50,000 jobs. I looked at some data from the Mizuho team. I think they said a number like 42,000 jobs created. So, not great job creation. We know it's taking a long time for borrowers to find a job. I think 25%, I read 25% of people without a job, 26% of unemployed individuals have been without a job 27 weeks or longer. It's over half a year. That's freaking brutal. So they got to kind of, now how does it help labor? Obviously, it helps small business, which employs 55% of all jobs in America, helps them get cheaper cost of funds, cost of capital to fund their operations. Could ease credit card balances and private loans, potentially student loans, and, lessen the debt burden out there. Of course, we've been seeing 57% of business out there the last, 6 weeks or so, at least in October, was refinance business. People are lowering their debt service at home by getting a lower monthly payment. That stuff matters, and that's more money pumped into the economy. So therefore, I see this as being the last cut for the foreseeable future on December 10th, because then they are 12 weeks removed from the September dot plot, and then they get the cover of the dot plot on this next December meeting. Remember, every other meeting they put a dot plot, also known as the Summary of Economic Projections. And they can say, hey, we're going to pause. We think we are really close to neutral. We're still a little bit worried about inflation. We're still data dependent. So if labor really weakens, we can do something later in the new year, but I think they're going to mail it in. And I think that ultimately will be seen as, okay, hawkish cut. The market anticipated it. We're past earnings season. There's a little quiet period before, the catch-up trade for all these money managers that have been bearish. I heard from a CNBC clip this morning. Jeffrey Siegel, who's a Wharton School of Business, I believe, or maybe it's Princeton, professor of economics. And he said, bearish books outsell positive bullish books 5-1. So I am just going to continue to be positive and bullish on all things because there's still 171 million people in America in the workforce with a 4.3% unemployment rate. People are still gainfully employed. People have, over half of homes are home free and clear. Yes, the top 10% of wealth in America, everyone's parents, if they still have them, if, some of ours are not alive, but, and my parents are certainly not wealthy, but, they have wealth and they have, equity, and they're helping younger generations, get into houses. And so, the family unit is still very powerful. Boomer widows still very powerful. So all this labor data, I think that the trend is your friend. And if I look real quick here at the 2-year treasury, which gives you clear guidance to cut, if we're going to use that as a barometer, it's a 360, 362. So I think there's room for another 25 basis points cut, but a hawkish cut. We'll get some minutes out this week. We'll get some more housing data. Bad news is good news for our business because rates get lower, but it's not terribly bad news. Like, no one's talking recession, right? So that's like the really bad news. So, this one big beautiful bill has a ton of stimulus, ton of tax breaks, which can, continue to pump up the GDP, which that data has been foggy because it's been distorted because of tariff uncertainty pulling through, imports and export data getting all wonky. Will that kind of like start to smooth out? Has been less than feared, of course. A lot of you wrote a lot of crazy stuff about the end of the world and 8% rates and 5% 30-year fixed. And I will point out you're all wrong. Whoever wrote that, I'm saying all of you, but like bearish outlook is so easy because your lizard brain, your little amygdala is bracing for impact. And we are not in the forest hunting and gathering, although we do hunt for loans. But, you relax. Like, there's a lot going on. We're going to the holiday season. Man, some of us are dealing with some stuff, personally, the holidays aren't the best. The days are getting shorter. There's less sun. There's seasonal effectiveness disorder. But in just about 8 weeks, 7 weeks, call it, the days will start to get longer. It'll be a new year. The Santa Claus rally will be in effect. 26 is coming out. Rates are in a great spot. Borrowers are watching rates stay in a low range for a longer amount of time. So they're really getting their stuff in order. We have more purchase, like we're up almost 30% year over year in purchase business right now, like in October, when it's, going into the fall and the days are getting shorter and people are bearish. And stock market's been, generally at all-time highs. Could sell off tomorrow as soon as I say that. But, we're in a good spot. 26 setup is pretty good. So lean in. Jevons Paradox. What is it? It's an effect where more efficiency increases the demand. So I'm going to give 2 examples. Houston, they built this whole highway. I think it was a stretch of I-10 where parts of it were like 26 lanes. It was a huge failure. The traffic was terrible, but the throughput was enormous. And so it was so much more efficient the more people used it. So there were a lot more people going through it, even though it felt obviously like crammed at certain pinch points. So Ethereum, which is like it's like almost like 75% of all like blockchain stablecoin projects. You hear about stablecoins, it's pulling some money away from Bitcoin. There's an effect there. And so Ethereum is like the Microsoft Windows of blockchain. Think like that. Whereas Bitcoin is like a more modern, usable digital store of wealth, like gold. Okay. With a shrinking supply, by the way, that can't be manipulated by, central banks like China hoarding it because they need to have that backup because they don't have enough dollars to conduct business around the world, which causes a liquidity crunch, which is the real reason the Fed wants to cut. But I digress. The Fusaka, it's like this upgrade to the Ethereum network. So imagine if Windows and all of our teams, which we love so much, and all of our efficient products, imagine Ethereum's capacity going from 30 transactions per second to 100,000 transactions per second. Banking, payrolls, transactions, tokenization of selling stocks, of selling property, of selling everything, of selling pieces of art, fractionalizing everything, ownership, all these things. AI and Nvidia is the center of the AI universe, is changing everything. We're seeing it. We're all doing less with more. I'll give you one last example here. Share some things on PRMG. The most we ever funded was $1.75 billion during COVID. We funded $1.4 billion last month with less than half the staff. We didn't make as much money, of course, per loan. The margins were crazy. Efficiency is taking hold on all these technology investments that all of our companies are making. And we're doing it and we're seeing it, and Jevons Paradox is playing out. I will get back to you Thursday with new hair. My 10-year-old daughter said, "Get the mullet done, Daddy." So get ready. Cheers. Hey, it's KP coming to you live from Newport Beach. It's Friday afternoon. It's just before noon. Just got done with our last word, Chrisman commentary podcast. It was a fantastic, lively discussion. Happy Thanksgiving for those that I won't see or hear. If this is one of my last videos between now and the holiday, it's a great holiday for us to come together and be thankful for what we have and help those that are in need. And it was definitely inspired on our call today. I read this week that the middle class, just a decade ago, people that consider themselves middle class was something like 80% of the country. And 10 years later, about 54% of this country is considered middle class. And 40% are lower class or working class. And, what does that say about upward mobility in our economy? And so that's why jobs are so important, for people to contribute to society and get back and, make money, earn a living, put some food on the table for their families. Food has generally slowed down its price of inflation, but there's nothing more deflationary than when your income goes to zero. And so how did labor come out? We got our first labor report since the BLS, the Bureau of Labor Statistics, reopened after the government shut down. When the government shut down October 1st, they were just days away from reporting the September jobs report, which is really the second half of August and first half of September, and surveys being completed and collected and compiled and then put out the first Friday of October. So what did it say? 119,000 jobs created. However, which is higher than expected, still not enough to keep up with the labor demands. If you look back at the average of all the labor reports this year, so then, the only other piece of good news was that wage inflation, wage growth, went up from 3.7 to 3.8% month over month. So if inflation's at 3, wages are going 3.8%, in theory, you're keeping ahead according to the way government looks at everything. But the bad news on that report is the 2 prior months were revised down another 33,000 jobs. So we've had some negative months of job creation because of backward-looking revisions. This September report may get revised down. I don't know that. But the unemployment rate went up. And it went up to 4.4% from 4.3%. Now, if you look at every Fed meeting, okay, they talk about the unemployment rate. In their dual mandate, it's full employment. So one of the things is they look at the employment rate. 500,000 new people entered the labor force for that September jobs report. So if more people are entering the labor force and there's less jobs to get, even at 119,000 jobs created, it wasn't enough. We went up to 4.4% in unemployment rate. Every other meeting, every 6 weeks, the Fed meets, but every other meeting they put out the summary of economic projections, the dot plot. They don't put the number of jobs created. They don't put that healthcare and restaurants created jobs in September and that manufacturing and government lost in September. They put one thing for labor, the unemployment rate, and that's it. Now, I know they look at other stuff, but the unemployment rate is the macro trigger for them. I think they cut. I think they cut December 10th. I think they do a hawkish cut. Yes, the Fed is divided. We know that from the Fed minutes that came out this week. We know that from the dot plots that have come out this year. But we get a new dot plot December 10th. And again, I've always said the dot plot is cover with anonymous dots. Of course, they go out and speak, and you can kind of tell who thinks what, especially when some of them are lobbying to get that Fed chair job. But the dot is an anonymous cover where people can say what they think, regardless of how they vote. They talk openly in a closed-door room, and they're probably a lot more candid with each other than we would ever know and ever see, or they ever share, on interviews or on their conferences or when they're on the speaking trail.
So the dot plot coming out December 10th, I think to do their last cut of 25 basis points. It's guaranteed. And I think they pause. And I think they'll pause at least 2 months for more cover 12 weeks later at the next dot plot. So that's my hawkish cut, risk management cut. Rates are high. And look what else is happening since the last Fed meeting. The dollar has gotten stronger. That's not good for multinational companies or for our trading and export out, because other countries around the world are not doing great. We're the best economy in the world by far. And other countries are hurting. So when the dollar is more expensive, U.S. goods and services and technology cost them more because our currency is going up. We need to weaken the dollar. What else is happening? Japan, slowing growth, high inflation, and they're raising their rates. And so the pen and that bubble has been pricked. And we're seeing a ripple effect in the equity markets as money sloshes around from different asset classes. And so Japanese central bank, strategy, theory, and execution, it does matter. It's one of the largest economies in the world. So I think we need to make our dollars cheaper. Obviously, here at home, it's great for us if rates for everything, including mortgages and homes, are cheaper for those in our business, our main audience here. But I do think it's a cut that they will do. They have a lot of bonds to sell. There's been some treasury auctions. We have a lot to do to fund our government, which still spends more than we take in. So we've got to make sure that we continue to manage that risk as well. Nvidia reported Wednesday, and they killed it, crushed it in earnings. They're still the center of the AI universe with a huge back order, sold out of certain chips. The AI trade is not going away. And stocks this earnings season overwhelmingly crushed earnings reports. That's good. Companies are earning. They're projected to earn again in Q4 and Q1. After that, not really sure what's going to happen. I'm not saying recession is in the cards, and I'm not calling an AI bubble collapse. But, there's a lot of money sloshing around. If you saw the market, it initially went up yesterday morning on the back of that Nvidia positive report. One of the best earnings reports of literally ever. 73% margin, $65 billion in sales, data centers booming, gaming chips up. So the market started to go up yesterday morning and then sold off in a very hard reversal. Every minute for 100 straight minutes, $15 billion was lost, almost $1.5 trillion in market cap evaporated yesterday in 100 minutes. Pretty scary. But if you're not a trader, don't worry. My guess is it'll come back. If you're in good companies that have good earnings and good free cash flow, you're going to be fine. I'm not a financial advisor. I am only responsible for your profits, not your losses. So, the flow of money is good. Rates are still at a very good level. The 10-year treasury is at a great level. And we just saw existing home sales up again. Okay. So, this is seasonally not the best time of year for people to be buying, but they're buying. So existing home sales, 4.1 million run rate. So if you look back 8 months, this was the best increase in existing home sales out of the last 8 months. That includes March, April, May, June, peak spring purchase season. Little old October beat them all on a month-over-month basis. So don't listen to anyone doom and glooming you. Go into Thanksgiving happy. We're in a good spot. Yes, it tends to slow down between Thanksgiving and New Year's, but things pick up. Bars are watching rates stay at this lower range for longer. It's encouraging for them to want to get their affairs in order and buy a house. 26 is going to be incredible. The Mortgage Bankers Association, they put up their most recent forecast a couple days ago, over $2 trillion in business they're seeing next year. Now, I thought it was interesting. They saw under 2% GDP for the next 2 years, which traditionally that's always meant we're in a recession. If you're not 2% is even, above 2% is growth, and below is recessionary. So they're forecasting recessionary GDP numbers for 2 years. I don't know if I believe that, but we'll see. 4.6% is the unemployment rate they think that December will be and will end this year. And they see the 10-year treasury hovering around 420, for the foreseeable future into next year. So, we'll see how it all shakes out. I'll leave you one last note. It's kind of a sad note, but there's a teenage boy that got hit by a guy who was under the influence down in Dana Point. It's like south of here in Orange County.
And guy just popped the curb and ran over this kid. Him and his buddy were on their way to school. And I couldn't help but think, if that guy was in a Tesla, that would never happen. Every single time I read an article about someone dying on the road, I just think, in a Tesla, that would never happen. 7 times more safer in a Tesla. 7 times than a human driver. So I'm a huge fan of safety. And I know a lot of people hate on Tesla or even Elon himself, but the car is great. And the full self-driving 14 version is fantastic. So something to think about as you're looking at the Black Friday gifts. I think it's time. And by the way, everyone that I've helped influence to buy a Tesla have thanked me. 100%. They're like, dude, this is like the best car, is so much better than I thought. So let's save some people on the road. Save yourselves. Have a wonderful weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.